Hey folks, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. Today is Monday, April 17, 2017, looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. We had a lot of similarities out here in the market today, and as we go through the different markets, we're going to see those similarities, and I have a feeling they do all come together. So they are part and parcel to my puzzle piece today of evidence of where the markets could be or should be pointing to. So first things first, when we look at the SPDR, on Thursday, we came down to a low of 232.51 against our previously indicated line of 232.34. So that was a near miss, but the market rallied today. And it was a pretty good rally in and of itself. It was persistently in an uptrend, consolidating, and then a last push up towards the end of the day. And that's a positive sign. There's nothing negative about that. That has to be taken as a bullish indicator. Tomorrow, we should punch right up into the moving averages at a minimum of the 50-period moving average that comes in at 235.15. That is my expectation for tomorrow. On the upside, we should get there based on today's close, unless we get something quirky happening overnight or potentially with some very poor earnings showings as we are entering in earnings season. Now, realize that earnings season could whip the markets around one way or the other. However, you have to take into context of where we've been and where we should be going. So, we've been trading down for about 6 weeks. We had a nice little rally in the middle there, but all in all, we've been going down to sideways for about 6 weeks. Any type of corrective pattern, which I think we're in now or should be finishing, that should last generally between 4 to 6 weeks. Sometimes a little more, sometimes a little less. So it's around 6 weeks. We are getting into the zone where the market should be making another turn and we should have another leg higher. That's what the cycles tell me we should be doing. Now, with that being said, we're getting into earnings season. So with the market being weak, obviously a lot of analysts are expecting poor earnings. They're expecting, along with the sentiment, they're expecting the market to correct a little further, and that's generally a good recipe for a market reversal. And I say we get some earnings surprises on the upside. It sparks the market into the next phase of the rally. And today was a nice little start potentially to that scenario with a nice update to potentially begin the next upside. Now, a couple of things to take into consideration. So we never did breach the low here, and that still is possible, certainly as we trade below the moving averages. So I don't want you to think everything's all rosy. There is another side to the picture, which is we could turn back down, breach the lows, and then we'd have to come into here, or worst case, here. Either way, the market should be running out of time on the downside, and we should be finding a low here pretty soon if we haven't found one already. We'll know pretty quick. A breach below yesterday or Thursday's lows is going to say we're going to at least test double bottom and most likely pierce through double bottom and potentially come down to the 230 area. That would be the next. Plan if in fact we did turn back down and we don't see any follow through tomorrow from today's positive activity. All right, so that's both sides of the equation. When you look at the IWM had much of the same day as the SPDR. We never did come down to double bottom. We're approaching the 20-day moving average on the IWM, but it was a nice day on the upside, leading the markets up 1.3%, up $1.75 on the IWM. And when you look at the hourly chart in the IWM, you can see here we had a nice little catapult off the bottom here, a pullback for a couple of 3 hours, and then a nice big thrust into the end of the day, the last 2 candles of the day into the 50-hour, 50-period moving average and the hourly chart. That's positive in and of itself on the IWM. So I'm just giving you kind of, all sides around the markets that I'm looking at. So there's your IWM. We saw a nice collapse down in the VIX today, down 8%. And if you remember from last week, I said, even if we pushed into one of these 3 areas, this being, the most likely to be hit, least likely, and less likely, which is the red line. And today we saw a nice big reversal day in the VIX. And that has to be taken with some level of conviction. We had a nice, solid reversal day taking out over 2 days of upside in the VIX, a big down day showing you that fear was getting sucked out of the markets, especially since we enter into the heart of earnings season this week. So it's interesting nonetheless, and I take that as bullish information. Of course, obviously we can get a reversal, but this was a reversal day in the VIX, has to be taken with some kind of conviction. In the transports, nice big up day in the transports, up 1.3%. So our 2 leading indicators, one being the IWM and the other being the transports, both up 1.3% today. That has to be taken with having some importance. Never breached the low in the transports. That has to be taken for something. We obviously came down and broke this bullish pattern that was developing inside this green candle, but that's the way the market is. The market's job, and I can't ever say this enough, the market's job is to trick and fool as many people as much of the time as possible, and that could have been one of the tricks up its sleeve last week by breaching the low, taking this bullish pattern off the table, and here we are potentially reversing right back up. We'll see what happens over the next couple of days. Now, when you look at the NASDAQ, which we've been looking at of late, you see where it came into the 50-period moving average. This is the upsloping blue trend line, and we had a nice bounce off that line today right into the 50-period moving average, so we remain sandwiched. Obviously, it closed above the 20-period moving average, which is the red sloping trend line. That's going to be positive. If we turn back down, something else is brewing. I'm favoring the upside, although notice the notice the NASDAQ was not up as much as our favorite leading indicators, which are the transports and the IWM. I don't know if we can make all too much out of that, and I will mention today that other markets around the world were closed today. In Europe, for example, I believe Hong Kong was closed. So there were some markets closed, so that could throw a little bit of a wrench in some of the activity in that we didn't have full participation around the global markets today. So we'll just note that, and we'll make sure that we maintain an awareness of that. And we look at the broker-dealers today, and we don't look at this every single day, but it is a leading indication for us when it is meaningful. And today we had a nice healthy up day, up 1.2% in the broker-dealers. That could be the sign of more to come in the financials. We know that the financials cannot, go up without the market, and the market can't go up without the financials. They are one and the same. The financials will go up with the market, and without the financials, the market definitely has a difficult time. So I'm watching the broker-dealers as an indication saying, hey, are the financials starting to catch a bid? And if the financials are starting to catch a bid, maybe there's a bid beginning underneath the rest of the market. Bank of America caught a nice bid today. Goldman Sachs caught a bid. JP Morgan was up 1.7%. So the broker-dealers were up nicely, and we have some additional bank earnings coming out. So I'm watching that closely, and if we can catch a bid in the financials, that could also cause a spark in the market. All right, going over to the gold market. Now here's where we're going to begin to see similarities. Now remember, we've been seeing gold trade in that correlative mode with the stock market, meaning inverse correlation in this case. As the stock market was having trouble and seeing downside pressure, gold was catching a bid and rallying at the same time. Not each and every day, but that was the directional move in relation to the stock market. Now, we saw a nice up day in the stock market today, and we saw an interesting, potentially reversal day in gold. It's a little early to tell. We could certainly just be putting in a sideways pattern for higher prices coming in gold. That's possible. But we did put in somewhat of a reversal in gold. And when you look at the intraday chart, now look at a 10-minute chart, for example, I see a collapse on a 10-minute chart. Now here's a bounce off the lows, but that's just the way the market works. But I see a nice collapse. As soon as we got back below $1,289.70, you can see here we stalled out. We tested it one more time, and then we just really traded away from it. And when you look at the hourly chart, we originally found some support here at these bottoms, this pivot low, this pivot low. Here's a breakout candle. So we found some support, and that's where we are now. But we'll see if there's more downside. Gold is going to want to come down and test that 1275, 1280 level, maybe 1278, in that neighborhood, which is a little ways away from where we are. Not too far off from where we are, but I'm just looking at it from a shorter time perspective. If there's any more downside coming, then there could be some staying power to the inverse correlation. And if the stock market catches a rally, maybe gold falls away all the way down, at least to the 200-period moving average, which is 1267, or potentially even in the 1258 area. That would be a test of the last breakout point, and that would be natural for gold to come back to do, and that would be a nice recipe if the market is catching a rally for gold to work off some of the overbought condition that occurred over the last several sessions. So that's what I see as a potential for gold. When you look at silver, it looks the same, and this is where I say some of the markets begin to look the same. You know, you have the same setup potentially in silver. We'll see what happens. We need more evidence. We're not going to make that kind of a predictive call, you know, in one shot based on one day up in the stock market and one day down in the metals showing signs of a reversal. But we do have a potential time factor for a turn in the market. And if that's the case, all these markets could turn simultaneously, not necessarily in the same direction, obviously, but they all could put in turns around the same time. So we want to be aware of what's going on in all these markets and see if we can find a tip-off for evidence that one may be leading in the direction that we're looking for. We might as well take a peek over at GDX tonight. And GDX, we talked about it stalling out around this level, the 200-period moving average, and also all this chart congestion in here. This is called chart vibration, consolidation. You can call it whatever you want. The GDX wasn't just going to walk through that area, and the 200-period moving average, at least for the time being, was a natural area of resistance. We'll see if it goes sideways. That may be telling us something, or it has a more meaningful pullback. That will also tell us something in relation to the metals themselves. All right, let's go over to the crude oil contract. And in crude oil, we talked about this level up here a couple of times, more than a couple times, it being resistance. Got as high as 53.76. It filled a gap. We talked about the fact that the 53.41 was going to be tough to get through. It pierced through it a little bit, put in, you know, I wouldn't even call this a pseudo doji candle, but it put in some kind of a candle that reversed the market, if you will. We're not going to call it anything. And now we're just putting in a sideways to lower consolidation pattern that's working off some of the overbought condition. However, it would be natural for the market after this kind of a run, it would be natural for crude oil to come back towards the moving averages. May not get there if it's strong, may only come down a little bit, maybe down to 52, 52 and a quarter. If it's very strong, that'll be what happens. If it's not as strong and it does a normal garden variety retracement, it'll come down to the 51 and a quarter, 51 and a half, maybe 52 area, probably below 52, at least into the moving averages. That would be a normal garden variety retracement. 51 would be a nice retracement, and if it put in a 51 number with sufficient time eating off the clock and the right look on the chart, that may be an area to go long crude oil and other potential stocks, if you will, or ETFs in the energy sector. So I'm just throwing that out there as a possibility. I'm watching crude oil for a nice little garden variety pullback to work off some of this overbought condition. Looking over at the bond market, here's another market that looks the same. So we had a short-term overbought condition in bonds, same as gold, same as silver. All three markets look very similar in nature and look in the chart. And this could be a reversal day, and it could mean lower prices coming, namely absolutely a retest of 152.23. That should be very simple for the market to come back down to retest that 152.23 area, especially off of what looks to me, it's not the ideal reversal day, but it's the makings of a reversal day. And if the stock market is going to rally and money's going to come out of the bond market, out of the treasury market, this is what happens. The stock market was selling off. Money was going into the treasury market as the price of treasuries were going higher. I had this black line up here at 155 and change, saying that if the market got up to 155 or higher, up to 155.20, I would be interested in shorting the bond market. Today we got up to a high of 154.15, came just a few ticks short of 155 and reversed. So I was looking for some kind of a pullback in the bond market, have it been being overbought on a short-term basis. And so we may see money flow out of the treasury market, which will push yields higher, positive for the banks. And if the banks can catch a rally in the stock market and the stock market catches a rally, the banks could catch an extra bid with money coming out of the bond market, pushing yields higher. I know that's a mouthful. Just rewind the tape. It's very clear. When yields come up, bond prices come down, that's positive for banks. Why? Because banks borrow on the short end of the curve and they lend on the long end of the curve. But when the long end of the curve has increasing interest rates, they're able to increase the money in which they lend you, and their borrowing cost stays the same. Their margin automatically increases as rates go higher. So if money's coming out of the bond market, rates go higher, banks do well. If the stock market catches a bid, the banks will exponentially go higher, and this could potentially be a tell also, like the IWM is, like the transports are, for a potential rally finally starting in the stock market. Remember, we're looking for a low in the stock market. So I'm looking at this bond market saying, is this the sign of a reversal or lower prices ahead for the bond market? We'll see. It looks like this was a potential tip-off for that to happen. Now, let's go over to the dollar. And in the dollar, we were looking for lower prices in the dollar. We saw that happen last week. You see this channel. We're having trouble with this channel. We ran into resistance once again. Let's see what happens in the dollar. Maybe it puts in a sideways pattern, setting up for lower prices. Maybe it rallies. Maybe it sells off. It's in the middle of a range. Nothing to do. I'm interested in buying the dollar down here. Absolutely. And potentially on a breakout above here. That is a possibility, not a probability. But this is definitely a probability, more than a probability. It's I want to buy the dollar down in that zone. So that's where we are with the dollar. And with that, I'm going to wrap it there tonight. I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.